The restructuring plan of the Iraqi banking sector. Who is Oliver Wyman? Oliver Wyman is a leading U.S.-based management consulting firm, part of Marsh McLennan, known for its expertise in strategy, risk management, financial services, restructuring, and more. What role is Oliver Wyman playing in the Iraqi banking reform? As of early 2025, Iraq officially launched a post-war restructuring project seeking to modernize its banking system. Oliver Wyman was brought on board to lead the private sector components of this effort. The plan includes reviewing banks' capital adequacy, liquidity, transparency, auditing, governance, and enabling healthy competition in line with international norms. Objective of the reform. The Central Bank of Iraq, CBI, launched a mandatory multi-year banking reform initiative starting August 2025, aligned with international best practices. The goals are enhance financial stability and governance, protect depositors' interests, enforce transparency and compliance, strengthen resilience and credibility of private banks, both commercial and Islamic. Non-compliance will result in penalties, corrective measures, or even license revocation. 3 reform pathways. Each bank must choose one of 3 corrective measures, Masarat al-Islah. Continuation, al-Istimrar. Bank keeps its current license and legal identity, must fully comply with reform standards independently, suitable for financially strong and well-governed banks. Merger, ad-Demj. Banks unable or unwilling to continue alone may merge into an existing compliant bank, joining as a subsidiary, or a new joint entity under one license. Shared responsibility for compliance and restructuring. Liquidation, a tasfiyah, voluntary or forced exit from the Iraqi banking sector. Bank loses license, brand, and operations, but must settle obligations with depositors and creditors. Minimum requirements. Banks must meet a set of stepwise requirements to qualify for their chosen path. 1. For continuation, by 31st August 2025, sign legal commitment to CBI. Pay annual non-refundable reform fee, $2.4 million USD per year. By 31st December 2025, paid-up capital should reach 400 billion IQD, equivalent to 300 million USD. Independent audit of capital and liquidity ratios. Submit audited 2024 accounts by Q3 2025. Full ownership disclosure. All shareholders are subject to enhanced due diligence. 2. For merger. By 31st August 2025, sign legal commitment. Pay annual reform fee, PO 1.2 MEM USD equivalent. By 31st December 2025, paid up capital on 250 billion IQD. Audited liquidity compliance. Submit merger plan, legal agreements, governance, risk assessments, post-merger business plan. 3. For liquidation. By 31st August 2025, sign commitment form. Exempt from annual reform fees. By 31st December 2025, maintain audited capital report. Submit liquidation plan to be supervised by CBI. Remain compliant with liquidity requirements until settlement. Evaluation and monitoring evaluation occurs in 4 phases, 2026-2027, with final compliance check in 2028. CBI applies 2 types of assessments, binary, pass, fail at specific deadlines. Progressive, staged compliance over time. Areas assessed include ownership structure and governance, business model sustainability, digital banking, customer service, ATMs, financial metrics, capital adequacy, liquidity ratios, stress testing, compliance, AML-CFT, sanctions, internal controls, transparency, contingency measures. If a bank fails to meet requirements, CBI may redirect it to another path, from continuation, merger, or liquidation, from merger, liquidation. Once removed from a path, the bank cannot return to it. CBI will issue formal warnings before enforcement. How will the central bank provide support? CBI will provide workshops, consultation, and a help desk. Issue detailed guidelines and timelines before each stage. In summary, every private bank in Iraq must either comply independently, merge, or exit the market. Each path has strict deadlines, capital and compliance thresholds, continuous audits, and CBI monitoring until final reform completion in 2028.